Good morning and welcome. We are delighted you are in attendance for what should be an informative and lively discussion about the California Small Business Loan Guarantee Program. This is Kim Casleonis. I am the founder and managing partner of Breakaway Funding, LLC, and the former CEO of Circle Bank, which served the San Francisco Bay Area for nearly 2 decades. Now, when the bank sale closed in November of 2012, I was introduced to the concept of equity crowdfunding and Title III of the Jobs Act. And it struck me that equity crowdfunding was brilliant for community banks. Why? Because equity crowdfunding is the vehicle through which business owners and entrepreneurs can raise equity from their community to strengthen their balance sheet and position them to be bankable or creditworthy. Now, I launched Breakaway Funding to facilitate this union, equity crowdfunding and traditional bank financing. We are an online capital raising and private equity platform operated by former bankers. And we are the creators of an emerging capital market we refer to as community capital, the engagement of all constituents in the community, entrepreneurs, investors, community financial institutions, collaborating to provide growth capital to propel innovation, job creation, and opportunities for investors. You may ask, why is a crowdfunding platform collaborating with a representative of the State Small Business Loan Guarantee Program? Well, simply put, equity crowdfunding and the California State Small Business Loan Guarantee Program both help your institution achieve the same goals: acquire new clients, generate new loans, increase deposit, improve earnings, earn CRA credit, and most importantly, continue to remain relevant. Our programs are complementary. For more information about how you can take advantage of a partnership with Breakaway Funding, please visit us at breakawayfunding.com/invest/financial institutions to download any number of informative materials or call us at 415-729-9482. Now, during our presentation today, we encourage you to ask questions. To do so, please utilize the conversation box on the right-hand side of your screen. We will take questions throughout the hour. Today's conversation is all about improving your loan funding ratio while mitigating risk. And if your institution was among those recently surveyed by Center State Bank, we know that approximately 75% of all C&I loans and 31% of all CRE loans are falling off your pipeline. But we don't want to take Center State's stats to speak for you. We would like to hear from you directly. So our first poll of the day will be a quick show of cyber responses as to what do you think your best guesstimate is of your bank's decline or fallout ratio. Please take a moment to type in your response what is your best guesstimate of your institution's loan fallout ratio. We will share the results from that poll in a moment. Adam Smith said, "It is not by augmenting the capital of the country, but by rendering a greater part of that capital active and productive that would otherwise be so, that the most judicious operations of banking can increase the industry of the country." To help us better understand how we can convert our bank's idle cash reserves to more productive capital for our economy is John Connelly of JR Consultants. John specializes in assisting business owners seeking access to the capital they need to grow and to create jobs, working with both SAFE-BIDCO and Breakaway Funding. With more than 23 years in the banking industry, from his initial training at Bank of America to working with Circle Bank, John understands the importance of strong due diligence, a complete credit package, and utilizing all of the tools available to lenders to get loans approved. He will be sharing with us how to utilize California's business Loan Guarantee Program to make commercial credit stronger and to improve your institution's loan approval ratio. And just in from our cyber poll, John, it looks like about 60% of today's participants have a very high ratio of loan fallout. So please tell us how we can improve those ratios.
Great, thank you, Kim. I appreciate the opportunity to speak to this group today, and to Kim's comments before, really hone in on how the California State Small Business Loan Guarantee Program can not only help you increase your loan funding ratio, but also help you with your other goals in as much as community reinvestment as well as fee income and deposits. So with that being said, I do want to reiterate that I work for both SAFE-BIDCO and Breakaway Funding. Today I am speaking on behalf of SAFE-BIDCO and our role in the State Small Business Loan Guarantee Program. Now, a little bit about SAFE-BIDCO. We were formed in 1981 as an act of legislation through the California State Legislature. We are a nonprofit, non-depository corporation, and we are a mission-driven lender as well as an administrative intermediary for the California State Loan Guarantee Program. We do two things at SAFE-BIDCO. We have direct lending in the form of rural loans primarily, as well as energy efficiency and agricultural. And then we act as the intermediary for the State Guarantee Program, whereby other banks will bring us their loans or lines of credit, and we will review and approve them in most cases for a loan guarantee, and then go on in an ongoing administrative capacity for the guarantee. I understand that our signal is a little choppy, so I'm hoping that my voice is coming through clearly. Now, a little bit about the history of the State Loan Guarantee Program. It's been in existence for over 30 years, and in that time frame, it's helped over 30,000 businesses achieve credit where they otherwise may not have. In 2011, as a part of the Jobs Act, which helps with the crowdfunding effort, as well as through the state program, we received $84 million pledged by the U.S. Treasury to help support the loan guarantee program within the state of California. When this occurred, we also received some new guidelines with those funds to help improve the program. Now, some of the parameters about the program and the changes that occurred with the funding from the federal government. There is now up to an 80% guarantee available with the state loan guarantee. It is applicable both to term loans and lines of credit. And the guarantee maximum was increased from previously a $500,000 cap to $2.5 million. So the guarantee is either up to 80% or to $2.5 million, whichever is less. Now, the term on the loan guarantee can be up to 7 years, and in the event that you want to use it for a line of credit, you'll have an annual renewal process. There is a 2% fee on the guaranteed portion of the credit at funding, and then an ongoing annual renewal fee for lines of credit upon annual renewal. There's also a minor $250 documentation fee associated with the program. The only size limitation for the state guarantee is relative to how many employees are working for the company. So any California business with up to 750 employees is eligible.
So John, we have our first question here, and the question is as follows. Related to the maximum guarantee term of 7 years, does this mean that the loan term must coincide with the guarantee term?
Yeah, that's a question that we often hear, and it's a good one. In actuality, we see a lot of lenders, a lot of banks that structure around the term of the guarantee but are not beholden to it. So for example, we see a number of transactions where a lender will have a 10-year amortized loan, some of which will have it come due in 7 years to coincide with the guarantee, but you're not required to do that. We've seen a number of lenders in the same example with a 10-year loan actually have the guarantee expire at the end of 7 years and decide to carry the last 3 years of that credit unguaranteed, with the idea that if they've made it 7 years through, they're unlikely to default in the last 3 years. We've also seen some very creative structuring around the program, and as much as it defers to the loan policy of the bank, a bank may, for example, for a large piece of real estate, structure a loan that is 35 due in 7 if they choose to do so. So it allows a lot of flexibility for the bank to both be creative and also to maximize their potential in pricing to win the business. Now I see that the slides advanced a little bit here, so I'm going to move it back here and talk about eligible uses of proceeds for the program. Like most business loans, you'll find that equipment purchases and installation of that equipment, working capital for payroll, as well as real estate purchases, refinances, and tenant improvements are all eligible. For business acquisitions, there is a federal guideline around the fact that it must be an asset purchase with this particular funding of the program, which allows up to $2.5 million on the guarantee. We also have the old version of the program in the state-funded version, which has been in existence for 30+ years, which allows goodwill to be included in the transaction, but we have to revert back to the old rules under that program, which maximizes the guarantee at $500,000. So there's a very big difference in the structure of a business acquisition and what might be available to a bank to choose from. We at SAFE-BIDCO will help you through that process and ensure that we utilize the most efficient program for you. The program is also available certainly for inventory and receivables. Now, here are some examples of where there's ineligibility. It's very similar to what you'd find for SBA. And a bank refinancing its own loan or a deteriorating credit, either their own deteriorating credit or one that they may be refinancing or taking on from another bank, is considered ineligible. And a deteriorating credit is something that is classified to a certain extent in special assets or has a high risk rating that would be determined by that bank. Also, this type of program cannot be used for speculative purposes. So if you have an investor, a real estate investor who's looking to flip properties, that would be an ineligible use. We also cannot fund partial ownership changes in a business. So if you have one partner who owns 50% who's trying to cash out and move on, you can't use this program to support buying only 50% of that business. It must be used by 100% of the business. And then also, an owner cannot reimburse themselves for their original capital contribution to the company, or an investor that may want to cash out of the business. So it's really intended for use in the business to increase economic activity, not to pay back owners.
John, we've got another question here. I'm sorry for interrupting. Yeah. Just real briefly, we've got somebody who wants to know, what if a client purchases a piece of equipment and then deploys it out of state? Is that an eligible or ineligible transaction?
Yeah, that instance would be considered ineligible. So the piece of equipment would have to be deployed within the state of California, as this program is designed to increase economic activity within the state of California, and SAFE-BIDCO as an intermediary covering the full state. We want to ensure that we are providing a catalyst for economic development within the state of California. A few other examples of ineligibility. These are, once again, very similar to our SBA lenders out there. You'll be familiar with them. You cannot pay delinquent taxes, cannot be used for pyramid gambling or lenders or speculators. You can't refinance debt that was originally used for an ineligible purpose. So if you have a borrower that, for example, was a real estate speculator that's moving their credit from one bank to another, if the original purpose of that loan was ineligible in nature, it cannot be refinanced under the state loan guarantee. And then one other unique property of this program, as per the federal guidelines, is that no borrower or lender can be convicted of sex offense. There's an actual certification required by both the bank and the borrower to certify that there are no sex offenders within their organizations. I'd like to provide some examples. I assume there's probably a few bankers on the line that are familiar with SBA, perhaps have not used the state loan guarantee program. And in comparison, there's really a few very significant differences. First and foremost, under the state guarantee, the bank may use its own forms, its own credit policy, its own terms, its own structure, monitoring, disbursements, you name it. This program defers to the bank by way of a bank being already regulated by the Office of the DBO or by the FDIC. They are considered eligible to use this program. They're already being regulated to the extent that's necessary. So hence, this program will defer to that bank's loan policy. Another big difference is that the state loan guarantee with a max of $2.5 million can be used on a line of credit. Now, most of you that have used SBA for lines of credit are familiar with SBA Express, where you have a maximum of up to $350,000. There is an SBA program called the CAP line, which allows for a higher limit, but is very onerous, requiring lots of monitoring and reporting by the borrower. Also, the fees are very different. For the state loan guarantee, you have a 2% fee on the guaranteed portion of the credit, where generally speaking, for SBA of any credit of any significance, you're looking at a fee of 3% and up. Also, a bank, if they're in a competitive deal, they can actually request for less than the full 80% guarantee. We've seen this in examples where a bank is competing against an SBA lender who has a 75% guarantee, and our bank that's working with the state program will choose to reduce the guarantee in order to bring the pricing down and win that deal. And I can say with 100% assurity, every competitive deal I've seen where an SBA lender is going up against a state program, the state wins every time. And I think one of the biggest and most significant differences on this program is that nonprofits are eligible. And one of the driving factors of this is that a nonprofit must have a recurring revenue stream that's not dependent on charitable contributions. So for example, if you have a church that's operating exclusively as a house of worship and they're dependent on their charitable donations, that would be ineligible. However, if you have a church that also has a school that is with registrants and they're paying their annual dues, we can look at that as a recurring revenue stream and include that in their overall debt service coverage capacity. So we like to work with the banks and help advise and counsel them through these types of scenarios. And once again, it's a very significant difference as applicable to nonprofits. Now, some unique scenarios that we've come across, as I previously mentioned, the not-for-profit lending, we've done some pretty significant transactions for both private and charter schools, as well as tax-exempt financing. We've also been approached to do EB-5 visa holder financing, where we have a situation where foreign nationals are looking to get an expedited path to citizenship within the United States. And this EB-5 visa program allows them to do that, essentially by having them buy or invest in a U.S. business of $500,000 or more. They now become eligible for an expedited path to citizenship. But in many cases, that $500,000 may not be enough for them to acquire the business, and they need to support that with some additional financing. So an EB-5 visa holder, which we're seeing more and more activity around that, oftentimes are needing to borrow the money, and they're eligible for the state loan guarantee. We've also seen the state loan guarantee used to mitigate loan-to-value shortfall for real estate acquisitions. And then we've also had scenarios where an owner or a guarantor had a minor legal infraction in the past. Most commonly we've seen DUIs some time ago for the borrower, and it's a big hassle for them if they're going through the SBA program in the 912 process where they have to get that cleared. The state loan guarantee does not have that requirement, and it makes it much easier for both the bank and the borrower. So some transactions that we've done in over the last few years, we did a $3.7 million hotel acquisition in the East Bay here. It was a scenario where the owner-borrower had maxed out his maximum with SBA, meaning he had fully utilized the SBA guarantee maximum. It was a very seasoned owner-operator wanting to acquire a new property, and we were able to help that bank with a state loan guarantee, full $2.5 million guarantee. We've also seen many businesses with less than 2 to 3 years of contiguous profitability. And most of the banks that I know want to see a minimum of 2 years of profitability before they're willing to do some sort of credit with them. And by way of using the state loan guarantee, you can help mitigate that risk. We recently did a $250,000 line of credit for a Napa Valley winery, as well as a $350,000 credit for an East Bay technology company that is growing very quickly. And as previously mentioned, we've done some nonprofits. I think that probably the most significant of which was for a charter school in Watsonville. This is a charter school that is helping the underserved, economically challenged area of the state, and it's a charter school that basically provides a path to college for lots of students that otherwise would not have that available to them. This was a campus that was completely built out from ground up, and the campus was owned by the school district, not by the school itself. So we essentially had tenant improvements done on a piece of land where we didn't have real estate collateral. But we had a bank that was very motivated to help out the community, and they were able to get this credit done with the assistance of the state loan guarantee.
Well, John, I've got to ask, here at Breakaway, we work predominantly with early stage and pre-revenue companies, and it's been a little bit of an education to try to get banks to and commercial credit unions to really embrace this hybrid funding that we've got going on. I'm wondering, does the state guarantee work for startup companies that are pre-revenue?
It certainly does. It's always going to be a case-by-case scenario, and the banks are going to apply their standard credit policy, but we have seen a number of instances for startups and the state guarantee coming in handy to help get them over the hump. Generally speaking, the owner guarantor needs to have some substance and a good, strong personal financial statement, good credit history, and of course experience in the industry. But we have done a number of transactions in that capacity, as well as in the capacity of SAFE-BIDCO pre-qualifying borrowers and helping to find a bank that participates in the program and placing them with the bank after we have already reviewed the credit, ensured that it was eligible, as well as done a preliminary underwriting of it before we hand it off to a bank with an assurance that we can get a guarantee associated with it. So it is not, it's more the exception than the rule, but it's certainly something that we see being done today, especially as the economy picks up and we see more competitiveness out there with the banks.
Well, that's really good news, and I think it really is. It's an untapped opportunity for community banks and community commercial credit unions to really take another look at, the future of their loan pipeline and their customer pipeline by embracing the startup and early stage companies with the help of the state small business loan guarantee program. So thanks.
Yeah, I would agree with that, especially for those companies that have strong balance sheets and equity that the bank can also rely on for their other goal metrics that they're looking to achieve. I also like to highlight a couple of the other benefits of the program. As I've mentioned before, this is a program that defers to the bank and their own loan policies, so it affords the bank quite a bit of pricing and structure flexibility. You don't have to fit everything within a box. You can get very creative to win the business, as well as to price it in such a way as to benefit the bank as well as the borrower. It also is a great tool to help increase the balance sheet, the assets on the balance sheet for the bank. Regulators also will look at the California State Loan Guarantee in the same fashion as the federal guarantee for the purpose of their loan loss reserves. We always encourage the bank to talk to their regulators about this, but the opinions we've received is that for every dollar that falls under the state loan guarantee, it's a dollar that you do not have to set aside for loan loss reserves, helping the bank preserve its capital. And then, of course, these are portfolio loans for a bank, so any loan that they book or line of credit that they book will count as an asset on their balance sheet. A couple of the other highlights I would mention is that by way of using the state loan guarantee, unlike SBA, a bank can actually enforce and mandate that the borrower bring their primary business banking relationship to the bank, thus increasing their deposits and their other fee-based services. Obviously a very delicate subject, but SBA does not allow for this, whereas this is not something that is not allowed under the state loan guarantee. So it's a great way for a bank to ensure that they receive all the other business along with the credit that they're doing. And of course, any credit that's done with the state loan guarantee is CRA eligible. A lot of banks these days, especially those that are acquisitive, are looking to improve their CRA standards, and this is a great way for a bank to do that. I'd like to talk a little bit about some of the elements of the program so that a bank can ensure that the guarantee will be maintained in good standing. And this relates in many cases to their ongoing monitoring and reporting. So the program requires that a bank submits a quarterly report to SAFE-BIDCO, and we actually have a tickler that we send out notification to the bank prompting them to provide us with this information. And we ask for three basic things: the current amount owed on the credit, when was the last payment date, and is the borrower current or past due. In addition to this, there's a requirement for annual financial reporting. So in the event that you have audited financial statements, those are acceptable, but in most cases we see tax returns and personal financial statements from the guarantors and the business. Then we also need the bank to maintain good open communications with SAFE-BIDCO. And that means if there are any changes to the credit subsequent to the funding, we need to be brought in to concur with those changes. So some of the examples we've seen here are when a borrower is converted to interest-only payments, or in some cases they're looking to release a guarantor. SAFE-BIDCO would have to be contacted, and we will need to issue an official concurrence to ensure that you maintain the integrity of the guarantee. Then, of course, if you have a borrower that's falling into a deteriorating situation, they're late on their payments, we want to be brought into the loop as soon as possible on that, because we work hand in hand with the banks in the event that there's a workout credit, or in the unfortunate circumstance of a default. We work hand in hand to ensure that if they have to liquidate collateral, that will occur. And in the event that the collection needs to proceed, we work with them hand in hand on that as well. As far as the submission process, it's pretty easy. A bank essentially is going to go through its normal underwriting of the credit and come to a final approved and signed credit authorization subject to the issuance of the guarantee. We would ask that the bank at that point complete a one-page lender's request form and submit that along with their full underwriting package. So we're going to look at the tax return spreads and any other due diligence a bank has completed. SAFE-BIDCO will then conduct an initial review and be able to confirm that we have a complete package within 2 business days. And then within 10 business days, we will pull our own loan committee together to do a review. And then upon approval, we will notify the bank same-day notification. And the guarantee will go into effect immediately and in concert upon funding of the loan. We will coordinate with the bank as far as drawing of loan and guarantee docs, as well as execution of those documents. They are done in tandem. And there's also the certifications that need to be completed. And we also coordinate with the bank to ensure that those are done in a timely fashion. SAFE-BIDCO is really an organization designed to work with the underserved across the state. And in that capacity, as I mentioned before, we also work with borrowers through our direct lending programs. But in many cases, we don't have a direct lending program that can fit their needs. So in those circumstances, we will look to see if we can help the borrower by pre-qualifying them for the state loan guarantee. And in that event, we then refer prospective borrowers to participating banks with these pre-qualified deals. And for those of you that are listening in today that would like to be a part of our network, I would ask that you please contact me. At the end of this presentation, all my contact information will be available to you. We're here to make it easy for our banks, so we also provide advice and counsel. We get a lot of calls and inquiries from banks that are looking at a transaction. They have questions. Is it going to fit? Is it going to be eligible? How do we structure it so it's going to fit within the program? And we provide a lot of front-end counsel in that capacity. And of course, we always provide prompt responses and status updates as the process is ongoing. In closing, I would like to highlight a few more of the key factors, I think, and areas that differentiate this program and should benefit the banks that participate. First and foremost, this program is substantially more flexible for a bank to use in fitting in with their own loan policy and mitigating their risk with an 80% guarantee. It really is a very simple program to use in as much as you don't need to change any of your standard processes, forms, or any of your underwriting in any way to fit this program. Also, as I'd mentioned, we refer a number of transactions that are pre-qualified to our participating banks. We have covered transactions all up and down the state of California, and we would like to increase the number of banks that participate in our network. Then, of course, and last but not least, use of the guarantee programs as a means to achieve your other growth goals, either through loans funded, deposits, fee revenue, or CRA credit. This is a great way to do that, and we hope that as a result of listening in today that we will be able to work with you going forward. Thank you so much. If there are any questions, we'd like to open it up to the group right now.
Well, John, while we're waiting for the participants to type in a couple of questions, we do have a few to ask you. The first pertains to nonprofit activity. So what kinds of transactions have you seen come through the small guarantee office as it relates to nonprofits?
Well, we've seen a couple of different types. I mentioned a few of the schools that are nonprofits, but we've also seen real estate acquisition as one of the types of transactions. And these are instances where the nonprofit is leasing a facility and they're looking to buy the facility. And then along with that, what we commonly see is that many nonprofits have endowments or other types of instruments where they are accumulating funds through donors and so forth. And in many cases, the bank will also benefit with gaining that business and the brokerage accounts associated with the endowments. So we've seen a number of those scenarios where those two types of business go hand in hand.
Excellent. This one pertains to the limit guarantee on goodwill, and the question is, why is there a limit of $500,000 on goodwill?
Well, with the federal program and the funding that came through that, there was a requirement that it has to be an asset purchase in the event of a small business ownership transfer. So in the event that we have a non-tangible asset or goodwill component to a business ownership transfer, we can revert back to the previous state loan guarantee rules where we still have funding left over. As I mentioned, this program's been around for 30+ years. So we still can revert to that in the event that we have goodwill components. Now, also on the horizon, we are looking to increase that version of the program, I believe, in the coming years, to be on par with the federal version to maximize the guarantee at $2.5 million. So we're looking for more information to come from that and to share that with our banking partners.
Excellent. We noticed that you are located in Northern California. However, can you or can the SAFE-BIDCO provide the guarantee for loans in either the Central Coast or Southern California?
Yes, we can. SAFE-BIDCO has a mandate to work throughout the state of California, and we've actually done transactions in the central area of the state as well as far as LA, some significant transactions. So we can cover anywhere within the state of California.
That's good. One united California. The next question is there a secondary market for the state guaranteed portion like there is with SBA?
Currently, there is no secondary market for the state loan guarantees. However, we are under the understanding that the iBank, who ultimately runs this program, is in the process of investigating and looking to set up a secondary market for the state guarantee. So stay tuned. When that happens, we will certainly broadcast that information to the banks.
Okay, and I think we saved the best one for last. Here it is, John. It is one thing to get a state guarantee and another to collect in the event of default. Can you talk to us about the state's historical performance on paying these guarantees?
Well, I can't necessarily speak to the whole state because I haven't had direct experience with all of the intermediaries that help us run this program or help the state run this program. But for the SAFE-BIDCO, what I can say is that in the history of SAFE-BIDCO, any collection guarantee, we have a 100% payout rate, meaning no collection request has ever been denied. We have been approached with situations where a bank may have fallen behind on their monitoring and reporting requirements, and we have seen scenarios where the guarantee may have been reduced from its original 80% to something less. But to my knowledge, there's never been a scenario where a collection has been denied.
Excellent. And I just want to, for clarification purposes, when we're talking about banks, we're also including the commercial credit union activity as well. Is that true?
Yes, that's true. And we do have a number of credit unions that participate, so thank you for bringing that up. I do want to also reiterate I referred to this earlier, but the state guarantee is what's referred to as a collection guarantee. So it does require that a bank, in the unfortunate event that they have a default, must first go through the liquidation process of whatever collateral is secured. There are some circumstances where the borrower declares bankruptcy and things get tied up in court. So in those circumstances, we'll generally pay out the full collection subsequent or pending liquidation of the collateral after certain court proceedings may need to occur. And then at that point in time, if there's any recovery, we work with the bank to kind of sort that out, and any component that needs to be paid back to the guarantee will be handled at that time.
Excellent. Well, thank you. Thank you, John. I would just like to have a couple of final closing comments. First of all, in addition to John's important takeaways, here are a few things that I'd like to just kind of drive home. And that is really leveraging the state guarantee can make the difference between a loan approval and a loan decline. And I know that we're all actively out there trying to get more capital into our economy so we can have local, healthy, sustainable neighborhoods. So certainly if you're not taking advantage of the state small business loan guarantee program, we ask you to do that and give John a call. Consider the SAFE-BIDCO and John as an extension of your business development activities. Again, they're in a position to help pre-qualify loans and introduce you to new commercial client relationships that the bank may be overlooking. And finally, as John described, I think in pretty good detail, it is really a very user-friendly program. Nothing against the SBA, but certainly to the extent that your borrowers do not have to complete a whole additional set of loan documentation, this certainly is a more user-friendly for not only the financial institution, but also for the borrower. So I'd like to thank John Connelly again for helping us gain a better understanding of the benefits of working with both SAFE-BIDCO and the California State Small Business Loan Guarantee Program to both enhance the funding ratio of our financial institutions, but also improving the overall health of the bank or credit union. Please, a couple of post-webinar items. We will be sending you a recording of this presentation for you to review again at your leisure or to share with your colleagues. So please, if you have any questions, call John or myself. We will be sending you also a post-webinar survey. Just give us your feedback. We would really like to make these presentations more valuable and applicable to your life. We have a couple of upcoming events just for notification of those of you kind of outside of the banking realm, but kind of sort of not really. Breakaway is in the business of helping entrepreneurs and business owners gain access to capital, thereby making them more bankable for you, banks and credit unions. So if you want to see some of the new and exciting businesses that are coming to fruition in your neighborhoods, please join us for our monthly pitch party. Our next event is this Thursday, April 16th from 11 o'clock to noon. Register on our site at breakawayfunding.com/events. Also, next week we'll be having the 1 Hour Banker, how to evaluate private equity investments like a professional. You can join James from Burr, Pilger, and Mayer, actually walk through Profit Sense. For many of you in the financial industry, perhaps you're using a SageWorks software called Profit Sense. It's a financial modeling software that we used at Circle Bank and we use here again at Breakaway Funding. So I'm happy to share that software tool with you. Again, if you have any questions about Breakaway Funding, about how equity crowdfunding can help you build your balance sheet, grow your loans, grow your deposits, earn CRA credit, and remain relevant both by itself and in conjunction with the state small business loan guarantee program, we welcome your calls and your interest. Again, thank you very much for joining us today. We hope you found this hour informative. We'll look forward to talking to you next time. Thank you.